Hello traders, recently I've been doing a lot of research into trading volatility and I wanted to give you guys just a completely free strategy, so let's dial in and do it. I've talked a lot about move contracts before. These are the FTX, basically a straddle where you can go long or short. Now, if you don't know what this is and if you don't know what implied volatility is, I recommend you go look up, type in FTX Bitcoin move contracts. Also type in what is implied volatility and learn a little bit about that, because that's a little bit beyond our scope, or beyond, it would take like a little bit too long to talk about. So what is the best strategy with these contracts? Well, of course, there's going to be no definite answer, but we do have statistics. Now, when it comes to move contracts, let me just walk you through a really quick rundown of how these work. We have basically two phases. We have the phase where the move contract does not have a strike price, and then we have the phase where it gets a strike price. It trades as just a volatility contract when it doesn't have a strike price. It trades as both volatility and it will fluctuate based on Bitcoin price movement when it gets a strike price. Now each day we have Saturday move, we have Sunday, Monday, Tuesday, you name it. These are all daily move contracts. They will almost every time, they will have a higher contract price on a Monday than they would on a Saturday. That's because there's more expected volatility on a Monday than there would be on a Saturday. But here's what I found. It's very interesting. What I found from back testing, I did a lot of back testing here. Unfortunately, it's not letting me back test anymore, but I will tell you what I did find. This was a 99. What I found is that even though move contracts have a lower price on Saturday and Sunday, meaning that the contract might start off trading at 438. What I have found is that here, let me go to this one. Where is it? Yeah, what I found is that even though the Saturday and Sunday contracts do have a lower price, that almost always it's actually worth shorting weekend volatility, even though they're priced much lower than they would be on, say, like a Monday, Wednesday, Thursday, or Friday. That was really interesting to me. What I also found was that the best strategy that when it came to trading weekend volatility was to short Saturday and Sunday move contracts, to put a stop loss at 2 times the price of where you shorted, and then just to hold out until expiration. That has a pretty good ROI. There are other ways to tweak it that we're going to go into, but that strategy in itself does have a pretty decent return on investment, just because even though these contracts have, are going to be trading at such a lower contract price when they become a move contract. I've said that word like a million times, moving contract. It's still worth typically shorting them because of just, the expected return that you're going to get, because they almost always expire below the price that they were put at. As you can see a little bit of it here. All right, so let's go into the nitty gritty of it. But before we talk about the fun part, implied volatility. So what you will notice is, of course, the implied volatility on weekends, on Saturdays and Sundays, is going to be a lot lower than the implied volatility would be on a weekday. That's very normal. But I've actually found that shorting at 40% implied volatility, it is quite low and it can be a little bit uncomfortable to do so. But I found it to be a lot better than doing something like shorting the move contract on a Monday or Tuesday or Wednesday when the implied volatility might be in the 70s. Just because there typically is a lot more movement on weekdays, especially when the US stock market does something a little bit wild and then Bitcoin follows that, we can get a lot of volatility. But on weekends when the stock market isn't really doing much, I think about a 37% implied volatility is justified and actually shortable. So if we look at the past Saturdays on the move contracts, what you can see here is a normalization. So the best time to short a move contract that I've found is to be when it opens as a move contract and gets a strike price. This is going to happen at about 8 to 9 p.m. Eastern time, or about midnight UTC. Okay? I found that the best time is to short then, actually, and then just to hold until expiration and put a stop loss 2 times the price of where you shorted. Now, whenever this gets to 2, that means that the move contract at its highest price would have touched your stop loss. Now, you might be thinking to yourself, wait, Bennett, it's going way above so many times. Yes, it is, but not on weekends. Look at the highest price on each of these weekends. Sunday, the highest this got was only 8% above the move contract, where the move contract was when it got a strike price. Basically, think about that where you shorted. This only went 8% higher. On this Saturday, it only went 3% higher. I mean, these move contracts just don't do much on weekends typically. Here, it went normalized max price on a Sunday. On Saturday and Sunday, it went what, like 8% higher here, 2% higher here. Where is it? Saturday here, it only went 26% higher. Sunday here, it actually wouldn't have hit your stop loss because it only went 95% higher, not 100% higher where it would have hit your stop loss. You know, you get it. This Saturday, it only went 69% higher, hence the 1.69. And on Sunday, it didn't even go higher than its original contract price when it did become a move contract, okay? So as you can see, on Saturdays and Sundays, these contracts barely go anywhere. They really don't go, do too much. And to show you a little bit of what they look like on a Saturday or Sunday when they're trading, we know that the October 1, I believe that would be the Saturday. Yes, that would be, okay. So the October 1, as you can see here, I mean, this thing just did not really go, it's still loading all the trades. That might take some time. Yep, here we go. But as you can see here, the move contract didn't even go above its price when it, got a strike price, which would have happened right here where my cursor is. This is really not that surprising. If we look at the Sunday, which was just, one day after, prepare your eyes because this might, go crazy again because it's going to have to load a lot of trading. But even on the Sunday, it barely went above when it got a strike price, which would have been the 2nd of October, that dashed line right there, as indicated right here. Yeah, you can see that. So as you can see, it's a pretty good strategy, even with lower implied volatility, to short move contracts on the weekend, to put a stop loss a little bit higher. An example of when, because you probably want to see when this doesn't go too well, because that can happen. We can go to a Saturday or Sunday where there was a lot of volatility as of recent. Let's look. It's not that often. Yeah, July 16th, kind of a long time ago. Sunday was, okay, Saturday, July 16th. Let's go look at that. So that would have been a time where you 100% would lose money with this strategy, because if you had shorted this move contract when it got a strike price, that would have been shorting right here where it says 16th of July, right around here. And as you can see, price went much, much higher than that, a lot higher. So that probably wouldn't have been too good. But the good news is that the stop loss, if you had shorted at about 320, that would have triggered around 600 something, and you would have only lost, I would say, probably would lose, like if you had shorted one contract, you'd probably lose like 300 to 400, probably like 300. But you would probably make a lot more of that back on the other Saturdays and Sundays that you had shorted. So that's really all I wanted to show today, that the expected profit of this, even with a lowered implied volatility, it looks like it's a lot better to short move contracts that expire on Saturday and that expire on Sunday. And the maximum prices that these reach haven't even been, they don't typically hit your stop loss. Now, the question of the hour is it better to, set a take profit or wait for it to expire? My strategy is to just typically wait until it expires, but some traders might want to look at the minimum price to see, what's the minimum price that this got to that you can put a take profit at. These can go very low, 23%, 0.23, 31%, and et cetera on the Saturdays and Sundays, but all in all, no matter if you pick take profit and stop loss or just stop loss and wait till expiration to avoid fees, this has been a pretty good strategy. Please don't put your entire net worth into this. You need to be very careful when you're shorting volatility. And I think that one last thing I do want to say about this kind of strategy, shorting volatility has a very bad rep, and it should. It should have a bad rep because shorting volatility unhedged can obliterate your account, and it probably will. What makes this different is you're going to be using a stop loss. You have to use a stop loss because if you don't use a stop loss, you're just going to get obliterated. It might not happen, in 1 week, but it might happen in like 7 after you've really grown your account. So using a stop loss is super paramount to this strategy. That's really what makes this tick. And then using a take profit or waiting for it to just expire can both can work as well. But as you can see, typically, these tend to expire pretty cheap. So it's, I found it better to wait for it to expire. So a final recap of the strategy, what is it? Well, what the strategy is not shorting the move contract when it comes out, but shorting the move contract when it gets a strike price has actually been more profitable. If you look here, when it opens as a future, it actually expires to 0.809, so 80% of its price that it was at when it got a strike price, and 63%. If we go to when it got it as a move contract, you can see it's lower here. So it's typically better to short it when it gets its strike price. So the strategy is basically shorting this when it gets its strike price, and then putting a stop loss anywhere between 2 times the price that you shorted or 2.5 times the price that you shorted the move contract at. Doing this over a very long sustained period of time while keeping your the amount that you use, I would say definitely under 10% of your entire account, and then just hopefully letting the profits compound over time. This is not a guaranteed strategy by any sense. It's just saying that recently, even with a 40% implied volatility, that is a little bit high because the stock market's not open on the weekend. And because of that, and with Bitcoin's ever-growing correlation to the stock market, shorting volatility on the weekends for Bitcoin has been very profitable because of its correlation to markets that are only open 5 days a week. So that's going to do it for this video. This is just some alpha that I found, some excess market edge. A lot of times, it can be a pretty profitable strategy. So that's going to do it for this video. If you want to get this website, it's completely free. I'm going to link in the description below. I'm also going to be linking a lot of my courses where you can find other high alpha plays more privately. With that, happy trading and get moving, pun intended.